Welcome back to the Chamber Music Mindset. I am your host, Anna Rathbun. Okay, we've got a lot to cover today. Let's get started. But I, as always, need to remind you that what you hear today in this video is only for information purposes and not at all investment advice. And with that, I'll tell you that the S&P 500 returned 0.37% last week, which was it was a good week. Except Friday, we ended in an interesting note because of the jobs numbers, and we'll talk about that in a few minutes. There were some notable names and notable events that happened inside of that index. So I'll mention 3 or 4 of them in this video. One was Google. Google knocked it out of the park. Google, and not for AI reasons at all, Google had been under some pressure, legal pressure, because there was this a lawsuit that the government's position was that Google acted in a monopolistic way with regards to its browser, Chrome. And the ruling, it was interesting, the ruling was that the search engine did monopolize the market. That was the ruling, but Google got to keep Chrome. So what gives? If it's a monopoly, you would break it up, right? Back in, I think it was 1999, I was still in college. There was that United States versus Microsoft. And the ruling was that it was a monopoly and the United States government broke them up. So the fact that Google got to keep Chrome was really interesting. I think it's because it's sort of obsolete at the moment. And that tells you just how delayed and lagging everything is in the US government when it comes to tech. Tech moves at the speed of light, but the government, by the time it pulls everything together, a lot of the stuff that is on the docket for discussion is obsolete, can be. In Chrome's instance, I think it's because it's obsolete, they got to keep it. Because let's face it, a lot of people I know use ChatGPT, Perplexity, and everything but Chrome or any regular browser to get their information from the internet. And frankly, it gives more comprehensive reports. They're not always right because it's just pulling from the pool of information that's out there. And who knows if they're pulling it from, a bad information source. But you don't have to click through a whole bunch of, websites that Chrome gives you in order to figure out if you can hit a website that'll answer your questions. And Google's AI, it's not that great because just before I got on this video, I actually asked Google, hey, Google, what did the S&P 500 return last week? And it gave me some absurd number like 2.07%. But I just told you it was 0.37%. So all of this is new, but this is just, it goes to show you that, by the time the tech government comes along to comment on the tech space, oftentimes it's late, especially when AI is moving at the speed of light. Okay, there were some AI themes in the market last week, and it had nothing to do with, some to do with NVIDIA, but nothing to do with the Max 7s per se. Western Digital was, I think it might have been the number 1 performer in the S&P 500. I don't know if you guys remember Western Digital. I used to buy Western Digital storage units. They were like this big. This is like 15 years ago, to be able to back up my my hard drive. And it's been kind of a sleepy type of a company, but because of this AI surge and the need for, data centers and storage, et cetera, it's actually gaining, I guess it was undervalued according to certain analysts out there. I think it was Morgan Stanley. Okay, the other news was Broadcom. Broadcom soared on the news that it made a deal with OpenAI to build and design new AI chips. So that is actually a threat to NVIDIA, who has basically soared on this promise of AI because they're basically the leading chip designer, right? So this news was not great for NVIDIA. It was great for Broadcom. So there's a lot of stuff happening in the AI world. This also goes to show you that AI, while, proof of concept is there, but the actual proof isn't there of everyday productivity gains or use cases for the entire economy. But it's making strides, and people are putting big dollars into this and making big connections and partnerships. So there's a lot happening very, very fast. No wonder Chrome is outdated. And the last bit of stock news is Lululemon. Did not do well. Consumers are not feeling up to it to spend a lot of money in Lululemon. They would rather go back to, I don't know, Walmart per se, or Burlington Factory that we've talked about in the last 2 weeks to get better deals to make their dollar stretch more. So Lululemon, another casualty of consumers not spending as much money on discretionary items. Now, what I think is very interesting is in terms of the whole market performance is that small caps or small cap stocks have been outperforming large cap stocks. This is very interesting because small cap stocks, and for those of you who are relatively new to understanding the markets, small cap stocks are just smaller businesses than large cap stocks, right? Large cap stocks are gigantic companies like Google and et cetera. Small cap stocks are just smaller. And they're viewed in the markets as a little more volatile, not always profitable, because they're constantly putting money back into their business so that they can grow to be mid cap and large cap. And so it's interesting that in this type of environment where we're saying uncertainty abounds, small cap is actually outperforming large caps. Part of this has to do with the fact that large caps, so the S&P 500 has run up so much and its valuation is so high and it is so expensive. And small caps, which had been lagging, did not have price appreciation to a point where it's super duper expensive. So this might be a little bit of a valuation based rotation, but I do think it's interesting because during times of uncertainty, people tend not to people like being in sure things like large caps where you have profits and you have earnings that are positive, and small caps are a little bit more risky. So I don't know what the market is telling us there, but that is an observation. Maybe it'll become clearer in the coming weeks. All right, let's go into our topics this week. I want to cover some economic updates from the data that received last week and the market reaction to it. And I do want to talk about some geopolitical news because that made a lot of splash last week, and the market reaction, what we're seeing in the markets, and I'm not talking about the stock market, I'm talking about the Treasury and commodity markets, that gives us a sense of what the sentiment is around some of these developments. That's mysterious enough. Let's get started. Okay, first topic is ISM manufacturing PMI. At the end of last week's video, I said that this is coming on for this week for manufacturing as well as services. And remember, services is very important because most of our economy is service-based. Okay, so let's start with manufacturing because that was what was released earlier in the week. We actually did better in terms of the headline composite number. It went from 48 to 48.7. But remember, anything below 50 is contracting, right? It's shrinking. So we're still shrinking in manufacturing. This is not necessarily good news. And we were expecting 49. So at 48.7, that was a slight miss. The good news is that prices paid. So this is what the businesses are actually paying for their goods that they're buying, their cost, went from 64.8 to 63.7. So it went down, moving in the right direction. But anything above 50 means that it is expanding, right? So we really need those prices paid composite index number to actually come down a lot more, but it's heading in the right direction. Employment index, this was not very good news. I mean, it went from 43.4 to 43.8, so a slight rising, so it's getting better. We were expecting 44.5. So again, a miss to the downside. Employment index being below 50 is a big deal because that says something about the labor market, right? Or the sentiment around hiring. And certainly Friday's jobs report showed a lot of confirming data. We'll talk about that later. One bright spot was new orders. It went up from 47.1, so from a contractionary area to 51.4, so expansionary. That was nice. This may have been, and I'm guessing here, a lot of people bought a lot of stuff before the tariffs, right? And then paused, and then now they need to restock. So I think there's a bit of a mini cyclical aspect to this, behavioral aspect, because of a lot of stuff that's going on in the global economy. Non-manufacturing, which is the services component, it actually followed the same pattern of what went up and what went down. Employment index was down, certainly in the contractionary area. It's a third month in a row of being below 50, so that's not good news. But the composite index, the headline index, went up to a 6-month high of 52.0 from 50.1. So that was a nice upside surprise. Take it when it gives it to when the market gives it to you. Take it when the data is positive on your side. Let's just celebrate that for what it is, knowing that there are some weaknesses underneath. And then, we need to look at some other data points to bring a picture together of what might be going on in the economy. Remember, all these data points, they're just, giving you like a one tiny little sliver of the economy from one angle in one methodology. It doesn't give you a whole picture. So it really need to take all of the data, put it together, and try to make a mosaic out of it. I think that's very, very important. Okay, let's go to jobs numbers. There was a lot last week with regards to jobs numbers, and they were not there. I didn't see good news last week. I mean, maybe you did and you can tell me about it. Let's start with job openings, the JOLTS. The number of jobs that are open out there fell from 7.437 million, which was actually revised down to 7.357. So already the month prior was revised downward, and then we ended up getting for last month 7.181. So we went from 7.4 to 7.2. That was not good, and the markets did not like it. Layoffs, the challenger layoffs, prior month was 62,000, and then that went up to about 86,000. So higher number of layoffs. So again, not good news. Thursday, we had the ADP give us some employment numbers. Prior month, so July, was 104,000. In August, we were at 54K. So it was pretty much cut in half, 104,000 to 54,000. We were expecting 65,000. So we weren't even expecting a high number, and yet we still missed it. So ADP on Thursday did not give us a good labor report. Now let's go to Friday. I told you last week we were waiting for this jobs number. This is the last BLS, Bureau of Labor Statistics number on the labor market coming out before the Fed makes its interest rate decision in September. Actually, I'm looking at my notes and I wrote, BLS. That tells you how I felt about it. Okay, we were expecting 73,000. So again, we weren't expecting a huge number. We missed it by an astronomical amount. The number came in at 22,000. 22,000. June, so actually, before we get there, I'll just tell you the unemployment rate went up to 4.3%. That was expected, exactly as we expected. Now let's take a look at, that's an August number, 22,000. Let's look at the prior months because we always look at those revisions. And remember, last month, it was a huge surprise to the downside when both June and May were revised downward, right? So let's take a look at what June and July were revised as. June, let's start with June, was revised downward by 27,000. So the number we had last month for June was 14,000 Now with the revision, we're at negative 13,000. So in June, we actually lost 13,000 jobs net. Okay, not good news. July was revised up by 6,000. So we went from 73,000 to 79,000. Okay, take it when you can get it. A positive bit of news. So if you combine June and July, it's actually 21,000 jobs lower than it was previously reported. Again, a huge miss when the numbers weren't that big to begin with. If numbers are like 300,000, I'm not going to make a big deal out of it. I'll tell you, but I'm not going to say, ooh, that wasn't good news. But when the numbers are this low and you're missing by 21,000 in terms of revision downwards, this is a big deal. Okay. So this was overall not very good jobs report. Now, I wanted to go down a little bit into the details here to paint, maybe give you some little colors on the picture that we're painting here. I think the first or second video I mentioned something about the labor market, that there's been this several year trend of part-time job numbers going up and full-time job numbers going down. So even though we're gaining jobs, so much of that is actually part-time, not necessarily full-time jobs. So the quality of the jobs gained wasn't as high. And it wasn't indicative of like a roaring economy, even though the numbers may have been high, which was being revised downward anyway, right? Okay, so last month, part-time worker numbers continued to go up, but actually full-time worker numbers also was higher than a year ago. So maybe compared to a year ago, we're doing really well. But take a look at this. Multiple job holders are trending up, and year over year, they are higher. The number is higher by nearly 250,000. Okay, so I looked into this a little bit further. So I'm just like, okay, who are these multiple job holders and what are they actually holding? Like, are they holding full-time jobs, part-time jobs? Because my guess has been that with inflation and high interest rates, all of these things, in order to make ends meet. And for a lot of people, it is about making ends meet. It's not about, oh, well, I just can't buy this something else, right? In which case you have to have a side gig or a hustle, right? So there is a data point that BLS collects. Primary job full-time and secondary job part-time. So we're talking about people who already have a full-time that has to supplement. They have to supplement their full-time salary with a secondary part-time job in order to make ends meet. It went from 4.8 million to 5 million. Okay, so that's nearly a 300,000 increase year over year. Okay, more people are on top of having a full-time job, having to have a part-time job, okay? So again, in terms of quality, not a great labor market. Now, I said this has been happening for a few years. You know, the economy and certain areas of the economy, unless there's a shock to the system like 2008 or tech bubble in 2000 or 2001 or a pandemic, deterioration happens in the fringes. So you sort of have to look at the fringes to see if something is weakening. And just because it's weakening doesn't mean you're going into a recession, but if it continues on, it actually goes into the corpus of the labor market or whatever you're looking at. So understanding what becomes a trend versus what's noise, it's hard, but it's also very important because sometimes it portends further weakness that may have a domino effect. I'm not saying that it's going to have a domino effect, but I'm telling you this deterioration in quality of the labor market job gains has been around for a while. And certainly the tariffs have made a lot of employers nervous and they are, pausing hiring. I mean, psychologically it makes sense, right? Now, in terms of market reaction, it was very confusing. So, earlier on in the day, it looked pretty good. Oh, wow. It started out pretty well because the idea is, okay, this was the last labor market data point we're going to get before the Fed meets, and it was poor. And therefore, it raises the likelihood that the Fed is definitely going to cut by 25 basis points. In fact, The markets, by the end of day, Friday, it was fully pricing in a rate cut of 25 basis points in September. In fact, again, it was actually pricing in two more for the rest of the year, nearly all three by the end of the year. So we're talking about a rate cut in September, a rate cut in October, and a rate cut in December. That's what the markets are pretty much pricing in. A few weeks ago, I talked about Michelle Baumann. She is one of the Fed officials who came out and said, we should probably have three before the end of the year. I thought about that and I thought maybe she was right. Now, this is the market's pricing it in, which is the market is betting on it. It doesn't mean it's going to happen. We will see. But certainly the markets were excited about it at the very beginning of the day, trading day. And then it went south. Because here's the thing. Are we supposed to be happy about a 22,000 jobs gained in the jobs market? No. Are we supposed to be happy about, 50-something thousand in ADP when the month prior we had 104,000? No. Less job openings? No. So the market is trying to price in, okay, what are we supposed to, where is the good news and where is the bad news? Right? What are we supposed to react to? And then at the end of the day, it ended up just selling off. Okay, so it was a very, very confused market performance on Friday, on a very, very important day for interest rate policy, monetary policy. We have one more week where we're going to have PPI and CPI. I'm going to talk about that at the end coming up this week. So every week leading up to the Federal Reserve meeting is important. Geopolitics. There's a lot going on in the world right now. I can't take the next few minutes and tell you everything I think about it. It would take a very long time, including going back in history. But I can tell you that I don't take everything that comes out of China seriously. I do view it oftentimes as propaganda. It is designed to rile you up. It is designed to make you feel like China is winning. It is designed to make you feel all sorts of things and get us into a panic. So the best course of action is not to do that and wait until real news comes out. But certainly, it made a splash. It was Mr. Xi, Mr. Putin, and Mr. Modi. It was basically Russia, China, and India. It looked like they were holding hands together and, rallying together. The reason why I'm skeptical is because Russia and China don't like each other and India and China don't like each other. And this dislike and distrust goes way back. It is more deeply rooted than those leaders themselves. So, forgive me if I take it with a huge grain of salt. However, there was one piece of news that did catch my attention and that brought a little more weight to the photo op, which was that Gazprom, which is an energy company in Russia, established a legally binding contract with China to build pipelines, like energy pipelines. That's real physical stuff and real money going into it in their land. That's commitment. Now, it takes a long time to build pipelines and it takes a long time to, build infrastructure around it. So let's not think too much about it, but it is legally binding and that had a little bite, right? And again, I don't know what's going to happen in the time it takes to build these things because they don't like each other. But it is a little bit of, I got a whiff of, East versus West again. That picture of Modi, Xi, and Putin together, and they're geographically together too on the Asian continent. It does give that feeling of we are together and binding together feeling of it. So it does give the sense of East versus West, especially because not too long ago we had our own photo op of Western countries, United States and European leaders in a photo op. And we were trying to seek peace in Ukraine and Russia. Okay, so I think this war is not necessarily coming to an end per se, as we had hoped. the trenches are maybe getting deeper. I don't know. I'm not a political analyst, but this is just from experience and also from how markets were reacting. So let's go to that, which is one thing I am good at. For this, I'm looking at the Treasury market, which is often a sign of trust in currency as well as sentiment and gold. So what happened was when this was all, the news was coming, the 30-year yield in Treasury market, so this is 30-year Treasury yield, went almost all the way up to 5%. It was touching 5%. It ended the week a little bit lower because of the flight to quality that happened on Friday with the poor jobs numbers. But people were selling U.S. Treasuries. On top of that, people were buying gold. Gold ended Friday at way over $3,000, $3,447. Okay, that was the last time I checked, actually. We started the year at $2,657 an ounce. January of 2020, let's go back all the way before the pandemic really began, it was a little below $1,500. Okay, so between January of 2020 and just now, it more than doubled the price of gold. While, and this was happening again last week, we were actually selling U.S. Treasuries. What's going on? So this is the markets telling us something because this is people putting money where their mouth is. Gold has been going up because of geopolitical uncertainties, and it really ramped up after Russia invaded Ukraine. And then U.S. put sanctions on Russian central bank and said that, yeah, that dollar reserve you have, you can't use it. It's frozen. So why in the world would we want to buy more dollars? If you were some other country, Venezuela, Argentina, India, trade is done in U.S. dollars, so you have to keep some in reserves. But what if the U.S. doesn't like something you do, and then it tells you, okay, now that's frozen, you can't use it? We were sort of using U.S. currency as a weapon. We were utilizing our reserve status for the U.S. dollar as a weapon. We were weaponizing it. That is not being a good steward of an important role in global commerce, of having that reserve currency. So central banks started buying gold. And it continues to buy gold. And now people are buying gold. And so gold demand has gone up because nobody's going to tell you can't spend that gold, because gold is sort of a universal, it's not a currency, but it has this universal value, intrinsic value. And people were selling treasuries. Again, this feeling that there's some division that is happening in the world that makes treasuries not as attractive. It used to be a very attractive thing all across the world, but maybe in 30 years, because this was a 30-year yield moving, maybe in 30 years, we don't know what's going to happen. I may not be wanting to own it, right? If I'm Argentina, I might not want to own this. I don't know, right? So this is the market's response to a lot of the global geopolitical events, is you can actually see it because we are globalized. We were even more globalized before. And there are financial instruments that move around this pipeline, this financial pipeline around the world. And if you pay attention to the things that drive those markets, you can sort of see how the world feels about what is happening. That maybe you can't quantify. You certainly can't quantify a photo op. You can't quantify, what kind of a detriment, a Russia, China, India alliance is going to be. That's hard to quantify, but certainly in the financial markets and financial instruments, you can see the reaction. Where would you put your money if X happened? Right? So it's giving us a certain probability. All right, everyone. Next week, we have I think I mentioned earlier, inflation numbers, CPI and PPI. PPI comes out first and then CPI. So it's, last inflation measure before the Fed meets the week after. Now, the Fed's PCE already came out. That's Fed's favorite measure of inflation, but certainly they take a look at PPI and CPI. Like last month, I expect PPI to give us more information about who is assuming the cost of these tariffs. So a lot to come there for next week. Consumer credit is also going to be making an appearance next week. I watch this pretty carefully because it gives us a sense of the indebtedness of Americans. Just not too long ago, we went over $1 trillion of debt. Not the best way to exist in being indebted, right? Our country is indebted. We, I guess, are indebted. And that's not even counting the buy now, pay later schemes that you've seen for several years now. So we'll see. We continue to add to the debt. And that debt, you know, the media likes to talk about it as if like Americans are so greedy and, you know, we have no discipline, etc. You know, there's certainly that too, depending on the person, but it is often the case that people are putting things that they can't afford to pay on credit. So we have to allow for that possibility as well. That says something about the state of the consumers and therefore the state of our economy, where it might be headed. And lastly, we have NFIB, business optimism. This is actually a measure of small business sentiment. Small businesses are the heart of the U.S. economy. It's very, very important. So getting the sentiment of how small businesses feel will be very important. Small businesses that actually import stuff from China or elsewhere, that has an impact, of course, on the optimism or outlook of small businesses in the next 6 to 12 months. So that'll be another important thing that I'll be looking for next week. And of course, market performance. So stay tuned for next week's video, and I'm signing out. Thanks for watching.